Welcome back to Morning Trade Live. It's time now for the big picture. So let's welcome in Cooper Howard, Director of Fixed Income Research and Strategy, Schwab Center for Financial Research. Okay, a lot of information to chew on this morning, Cooper. What did you make of all the data we got? Let's start off with ADP.
Yeah, that was definitely the big one that the market has somewhat focused on. What really stood out to me is obviously we got the headline print that was a negative number when the market was expecting a positive number. So negative on that side. But I think looking under the surface, if you looked at the smaller businesses were the ones that were feeling the pain much more than larger businesses. So I think that that's something that is important to watch for the economy. Also important to watch for the Fed. And it does point to this kind of K-shaped narrative that we're seeing in the economy right now, to where larger businesses, also individuals with higher incomes, more higher net worth, are facing a better time relative to those who are lower net worth and smaller businesses. So I think that it's just another quiver in that narrative of the K-shaped economy, Sam.
Yeah, what do you make of, when we scratch the surface on this ADP, what we saw beneath it? I mean, a lot of the weakness is coming from the small businesses. I mean, there's been some conversations being thrown out this morning about how we're perhaps seeing some maybe even recession when it comes to small business job losses there. 120,000 as far as a decline there, as opposed to large companies, which had an uptick of 39,000. I mean, what does that tell you?
Yeah, the big caveat with the ADP number, though, is that it isn't the traditional non-farm payroll labor market report that we regularly receive. So that's the gold standard. The government released data is the gold standard on that. So that's the big caveat in terms of the ADP number. But it does show that there is some weakness under the surface. So it is something that I think that is important to watch. Now, going back to the question about a recession, I think it's too early to show that we are in a full-blown R recession word. Now, there might be pockets of weakness in the economy. I do think that that's something that's starting to show up, like we mentioned earlier, those K-shaped recovery. But looking at a recession, overall, if we look at the unemployment rate's still in the low 4%. Yes, it has been moving up, but historically, low 4% is considered full employment. So we still are looking fairly good as a overall economy. So I don't think that it's in a recessionary environment right now, Sam.
So the markets are baking in a very high probability of this cut come next week. So it does seem like the conversation is shifting somewhat from what they will do to what they say. I had a conversation yesterday with an analyst and an economist who was sort of suggesting that we could be getting somewhat of a hawkish cut. Now, that obviously is going to feed into, what the expectations are come 2026, with the fact that, you've had the more hawkish voice within the Federal Reserve talking about how prices are still too high. And look, the labor market, while it's softening, it's not disastrous. What do you make of that? And what could be the potential reaction in the markets off the back of what could potentially be a hawkish cut?
Yeah, I think that that's a very good point, is that we might see a hawkish cut next week. Like you mentioned, all expectations are that we are going to get that rate cut next week. That's our expectation. That's most expectations across the street right now. But if you look further out, I think that that's where kind of the question mark is going to be. Our view is that they're going to cut again two to three times next year. But it's largely going to be dependent upon how the labor market develops. I wouldn't be surprised if it's fewer than 2 to 3 cuts, because inflation is still running above their 2% target. So at this next meeting, a cut and then pause would not be too surprising. And if that were to occur, I wouldn't be surprised if we start to see yields still remain in this range-bound narrative that we've seen lately. So we've seen the 10-year Treasury trading around 4%. It's been very difficult to break out of that range and hovering right around there. Going forward, I wouldn't be too surprised if we continue to hold that range-bound looking out a little bit.
Yes, we've got the 10-year obviously coming off that yield, so bonds catching a bid this morning. We're at 406 on the benchmark right now, but as you and your colleagues have been pointing out, we do have also some global fixed income factors here for the US Treasury market too. Just sort of looking across obviously fixed income, I'm just wondering, where you see opportunities right now.
Yeah, so if we look at what we're discussing with our investors right now, Sam, we are suggesting that they focus on a benchmark duration for an average investor that's about 6 years, and then focusing on higher rated investments. We do think that spreads, concerns about potential slowdown in the economy going back earlier, we're not obviously expecting a full blown recession, but a little bit of a slowdown in the economy and where spreads are does suggest focusing on higher rated issuers. Now, one part of the market that we do think can be an area of opportunity is the municipal bond market. Now, a big important piece here is that they are types of bonds that generally pay interest that's exempt from federal income taxes, Sam. So it really makes sense to hold those if you are in a higher tax bracket in a taxable account, something like a brokerage account, for example. So we do think that looking at yields after adjusted for taxes, they are fairly attractive compared to alternatives. And then credit quality continues to hold up relatively okay, and it is fairly stable going forward. So many municipalities have built up their liquidity positions, and that can go a long way if they do face a slowdown in revenue. So we do think that the muni market can be an area of opportunity for those investors who are in higher tax brackets, Sam.
Great stuff, Coop. Always appreciate it. Thanks so much for joining me today. Cooper Howard there, Director of Fixed Income Research and Strategy, Schwab Center for Financial Research.